Good afternoon and welcome to BizTech's Asian Midday Market Watch. Today, powered by Smart Investor Singapore. I'm Brian Fernandez and it's Thursday. We have our regular guest, David Kuo, founder of the Smart Investor out of Singapore. David, good afternoon.
Hey, selamat tengah hari, Brian.
Now, David, before I come back and get your insights, we're going to take a quick look at crypto markets. We're also going to take a look at how regional stock markets have performed. We're going to start with now Bitcoin, which is at 19,080. It's down 0.09%. Ethereum is at 1,283.79. It's down 0.61%. Now, looking across the regional stock markets, the SGX is down 1.16%. The KLCI is down 0.14%. Shanghai is moderately just unchanged. ASX All Ordinaries is down 0.01%. The Nikkei is down 0.5%. The Hang Seng is down 1.4%. And rounding up the numbers, we've got the Kospi, which is down 1.24%. So it's pretty much a sea of red, David. Tell us why.
Well, there was one that was actually in the green until you started talking, and then you introduced me, and then that turned red as well. So it's not making me feel any better. But I think really what people are waiting for at the moment, Brian, is the CPI numbers that will be coming out later on today from the US. People are very concerned about what the Fed's reaction will be when they see those inflation numbers. And certainly last night, people were poring over the Federal Reserve meeting minutes, and they were hoping to sort of find some clue as to whether or not the Fed is likely to pivot. And after poring through the entire transcript, they came to the conclusion that there is going to be no pivot at all. And the Fed is really determined to carry on with its path of monetary tightening, and they will continue to do that until they bring down inflation. So with regards to the CPI numbers tonight, it's likely to be north of 8%. It's going to be slightly better than this time last month, but certainly not good enough for the Fed to even contemplate or think about pivoting in any way. So it looks pretty much as though the 75% basis point rate hike next month, beginning of November, is baked in, and probably another rate hike in December. So not a very good Christmas present for everybody this year.
Now, it's not all bad news, but and the theme of today's show is really around the good, the bad, and the ugly. Now, let's start with the good. And yesterday we had company earnings. It's earnings seasons now. As PepsiCo earnings were out yesterday. Tell us a little bit more about that and why you're bullish on PepsiCo.
Okay, we're talking about the good, the bad, and the ugly today. So we'll start off with the good, Brian. I almost feel as though I should be wearing a cowboy hat and putting a cheroot in my mouth and pretending to be Clint Eastwood. But as far as the good is concerned, there were some good results from PepsiCo last night. Third quarter numbers, revenue was up over 8%, and earnings per share was up 22%. So it looks as though PepsiCo is on the right path. And it just goes back to what I was talking about months, if not longer, about the kind of companies that people should be focusing on, the things that people can easily afford or the things that people cannot easily do without. And I think PepsiCo falls into that first category, that you can easily afford a Pepsi if you need to go out and buy a soft drink or something. And if you generally ask people how much does a can of Pepsi costs, they will turn around and say, I have no idea. What, $1, $1.50, $1.20? I don't know. And I think, that is really the secret behind the success of PepsiCo. It has that ability to increase prices. And when I looked at the gross margin for PepsiCo, it was as strong now as it was a year ago. So somehow the inflationary pressures is not affecting PepsiCo as badly, and they've been able to increase prices, which means that they've been able to protect their gross margin. And of course, later on this month, we'll be getting numbers from Coca-Cola, Unilever, Procter & Gamble, Abbott, 3M, a whole host of companies. And I'm looking forward to seeing what they have to say about their quarterly profits and quarterly revenues, Brian.
Then how about the ugly, David? What are the ugly elements of the inflation bugbear? Obviously ugly.
Well, the ugly element, of course, is valuations. As the interest rates go up from the Federal Reserve, it means that it's likely to pull down that PE ratio. In the past, people were prepared to pay, 30, 40 times earnings. Of course, these days, they have an alternative. They don't always have to go into the stock market to get some kind of yield. And the yields that I'm talking about are 10-year treasuries. So a lot of people will be comparing the earnings yield, or the inverse of the PE ratio on the stock market, with what they can get from a risk-free investment such as the 10-year treasuries. And as those 10-year treasury yields start to increase, then of course the PE ratio will get pulled down. But people need to remember that there is a big difference between share price performance and PE ratios. The share price performance is a function of the PE ratio, but it is also a function of the earnings per share that companies are able to generate. So whilst the PE ratio may come down, if you get companies like PepsiCo that are going to be reporting 20% increase in their earnings per share, then it could actually sort of provide that sort of kind of support for the share price. So that is the less ugly side of the ugly side of valuations, Brian.
So we've talked about the good, the bad, and now the ugly as well. The other thing that's ugly is really what's happening in the UK with pension funds.
Right. I mean, the really ugly side of what is happening in the market is that things will break, and we saw this in the UK with regards to the pension funds. They were at breaking point and almost at the point of collapsing. And what these pension funds had to do was to go to the Bank of England and say, you've got to help us because we are having to sell off UK treasuries, UK gilts, in order to support the cash flows that we have. Part of the problem was self-inflicted to some extent in the UK pension industry because they were borrowing money to buy gilts, right? And of course, when gilt prices started to come down, they had to get rid of those gilts. They had to sell them into the market. It was almost like a fire sale. They had to sell the gilts in order to satisfy the margin calls on the money that they had borrowed in order to buy the gilts in the first place. So the Bank of England have given them a breathing space and said, you got to sort this out. And I think on Friday, the Bank of England said, we're not going to be supporting you anymore. You've got to sort it out yourself. And I think that really is the ugly side of what's happening in the market. We don't know where the break points are, Brian, and things are going to break as interest rates go up. Not every company will be like PepsiCo that is able to survive, but there will be companies out there. And I think where the problem will lie is when people are over leveraged, when companies borrow too much, as in the case of the pension industry. So what is next going to break? I have no idea, but I suspect it could very well be the property market because we're already seeing what happened in China. We've seen the property prices in Hong Kong come down, and any company that is over leveraged needs to watch out because as those interest rates go up, things are going to break, Brian. So I hate to leave you with such a sour taste in everybody's mouths, but hopefully people are going to be forewarned, which is a case of being forearmed, that something is going to break, and just make sure that you yourself is not over leveraged and let other people break, but don't break your own personal finances, Brian.
So I think the key message for today is deleverage.
Yeah, I think so. I think it is leverage because leverage is going to break a lot of things.
David, thank you very much for coming on the show, and thanks for your insights.
You're welcome.
Now, we've been speaking to David Kuo, founder of the Smart Investor in Singapore, on BizTech's Asian Midday Market Watch, powered starting today by Smart Investor Singapore. I'm Brian Fernandez. This interview will be on our website, www.biztech.asia, as well as our social media platforms. It'll also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.